pick the right stock at the right time.
Good morning, it's Daybreak, this is Bloomberg Quint and I'm Alex Matthew. First, the headlines. Asian markets edge higher as US Treasury yields hold steady at a 10-year low. Some of Fortis Healthcare's minority shareholders called for an extraordinary general meeting to remove 4 directors from the present board. ACC reports a strong set of numbers in the first 3 months of 2018. And it's an earnings-heavy day today with 2 nifty companies, TCS and IndusInd Bank, coming out with their quarterly numbers. And turning to international markets, first with the US markets, Wall Street stocks finished mixed on Wednesday, with the S&P 500 and Nasdaq closing with marginal gains, while the Dow declined. Investors stay on hold as the earnings season progresses. IBM's disappointing outlook weighed on the Dow. Bloomberg's Abigail Doolittle sums up all the action on Wall Street in this report.
Stocks finished mixed in Wednesday's Wall Street session, with the Dow falling slightly. The S&P 500 and the Nasdaq both climbed, but it was very, very modest relative to the S&P 500. The index climbed by about 0.1%. The Nasdaq climbed by about 0.2%, and the Dow's fall was by a little less than 0.2%. So not a lot of movement overall, as investors appear to be on hold as the earnings season progresses. But one big drag on the Dow, helping to explain that slight decline, IBM, Big Blue. Shares dropped more than 7% for the worst day in about 5 years. This after the company reported its first quarter, and investors were disappointed by the lack of sales growth along with a decline in gross margins. Now, not surprisingly, the tech sector for the S&P 500 fell, not being helped by IBM. And in fact, 6 of the 11 sectors traded lower, 5 higher. As for that small gain for the S&P 500, the 2 top sectors which outperformed, energy and the industrial sector. Energy up more than 1% in sympathy with oil, which climbed in a big way, up more than 3% in the context of a bullish inventories report. As for the industrial sector, CSX was a big winner there, sharply higher on a strong first quarter earnings report. But we also had the likes of Boeing, Caterpillar, and General Dynamics also helping out that industrial sector. And while the stock gains were slight for the S&P 500 and the Nasdaq, and the Dow actually fell just a bit, interestingly, we had Haven bonds pull back to some degree, as did the Haven yen. So a bit of a mixed picture, not a lot of movement in Wednesday's Wall Street session. In New York, Abigail Doolittle, Bloomberg News.
Now, before we tell you about the Asian markets, there was a big update in the geopolitical space yesterday. US President Donald Trump said he hoped that the planned unprecedented summit with North Korean leader Kim Jong-un would be successful after a recent visit to Pyongyang by CIA Director Mike Pompeo. He warned, though, that he would call the entire thing off if he thought that it did not produce results. Listen in.
I will be meeting with Kim Jong-un in the coming weeks to discuss the denuclearization of the Korean Peninsula. Hopefully that meeting will be a great success, and we're looking forward to it. It would be a tremendous thing for North Korea and a tremendous thing for the world. So we will be doing everything possible to make it a worldwide success, not just for the United States or South Korea or North Korea or Japan, but for the entire world.
All right, let's take a check on the Asian markets, and they've clearly opened positive, with the Nikkei in Japan up nearly 0.8%. We'll have to see how China opens, but the signs are good. Let's turn to the Indian market now and see what's panned out for today. Jayesh Kilnani and Agam Vakil are here to set you up for the day's trade and also to tell you what's happening in the futures and options space. Jayesh, the cues look decent. The SGX Nifty is suggesting that there will be an uptick.
That's right, Alex. So the SGX Nifty is suggesting, open near the 10,600 mark. At the moment, it is trading about 30 points higher, but just a few minutes back, it was in fact 50 points higher. Mind you that this is in line with what global markets also did yesterday. They actually paired gains, and in fact, the Dow Jones snapped its two-day winning streak. So most of the global markets also ended lower from where they had started. So this is absolutely in line with what global markets also did. But let's look at how the ADRs actually closed. Once again, a mixed close, but no major moves except for Wipro, which ended nearly 2% lower. We had ICICI Bank and the others which also declined, and we had Vedanta, which actually gained in trade, and Infosys also managed to eke out gains for itself. But plenty of cues coming in as far as the commodities market is concerned. Mind you that yesterday the entire commodity space was rather muted, and today the entire space is buzzing. So oil, for example, that rose nearly 3% overnight and has actually continued its gains this early morning as well. If you look at the base metal space, some big moves coming in for aluminium and nickel. So aluminium in fact closed about 5%, more than 5% higher, and this is in fact the 5% gain. In the last 3 days it has posted 2 times, and we had nickel which surged 7.5%. Copper and zinc, in comparison look small, but they also gained about 2 to 3.5%. So wait and watch how the metal stocks actually react to this. Gold prices also, right now trading flat. However, we did close overnight above the 1350 per ounce mark. Now let's look at the fund flows that we got for our domestic market. Once again, the foreign institutions, they have sold more than 900 crores. This is the second day that they have sold, more than 900 crores in a stretch. So the domestic institutions actually pumped in about 867 crores. But for the month, the trend continues. The FIs have sold nearly 2,500 crores, while the DIs have pumped in more than 5,000 crores. In terms of some of the key indices, so the Nifty ended about 22 points lower. Important to note that it actually snapped its 9-day winning streak and ended lower, followed by the mid cap index and the small cap index, which also traded lower for the day. In terms of where the gainers came about, that was the Nifty FMCG. Second day in a row it has actually topped the charts, followed by Nifty Media, about 1.4% higher for that one as well. In terms of the losers, it was primarily the banks. So the Nifty Bank and the Nifty PSU Bank, both of them declined in trade and were the top losers in trade. As far as the volatility is concerned, no big moves coming in, but it did manage to surge about 0.5%. So if you look at the contribution that led to the 22-point fall in the Nifty, it was largely led by the private banks, HDFC Bank and Axis Bank, followed by Reliance and HDFC. On the gainers, we had ITC, Wipro, Ultratech and Z. So that's largely how the trade setup is looking. But Agam's here to take us through the F&O space.
Right, Jay. So what we've seen is a consolidation, and I know that Nifty snapped its 9-day gaining streak, but at the end of the day, we're still looking at the Nifty holding on to the 10,500 mark. With respect to the futures, not too much change. Coming down to the Nifty Bank as well, largely in line with what we've seen the Nifty do, and as a matter of fact, seen a little bit of decline with respect to the open interest. What does it mean for the India Wix? Again, not too much to speak for. Still around the mark of 14. The Nifty put-call ratio also has hardly changed at around 1.59. And with respect to changes in open interest in options, now looking at more writing in the 10,500 put, surprisingly, and of course unwinding otherwise in the 10,300 put. But moving on, in terms of stocks, so we're watching out for Jet Airways, which moves into the ban. So we're expecting some restricted trade there. Of course, we had the aviation data come in yesterday. V-Guard is looking at a substantial increase in open interest towards fresh longs. And on the other hand, we're looking at Amara Raja Batteries, which is also looking at a near 8% increase in open interest towards longs as well. So plenty of stocks out there to keep an eye on. And once again, it will likely be a day of consolidation, at least as per the indications of the SGX Nifty for now.
All right, thanks so much for that, Agam. And Agam will be back very shortly to talk to you about the F&O space. That's at 10 o'clock. He will also have his hands full with the IT space because TCS announces its results. And speaking about IT, Nilesh Shah of Envision Capital is bullish on the Tier 2 technology companies. Speaking to us on our special show, Alpha Moguls, Shah believes that the weakness in the rupee will further aid the margins of such companies. Here's a slice of that conversation.
So I think what we've seen in the technology space is that, I think by and large, most of the players in the technology space were clearly kind of becoming reasonably well entrenched into some of the new tech or the emerging technology kind of areas. I mean, obviously, of course, things like digital and all of that. But what we really started to see is that some of these companies have started doing a lot of commendable work in that space. And what we saw was that, or what we thought then was that over the next 3 to 5 years, these new areas will become a much larger part or a component of the overall revenue pie for most technology companies. But within that, what we saw was that the tier 2 technology companies, they essentially were doing even a better job because of their focus, and because that the size was relatively small, their ability to turn around in terms of the business model was much better. They had a greater flexibility in terms of basically changing their business model. And what we thought that is that they had already spent the last 2 to 3 years trying to do this. And I think they've been meeting reasonable success on that front. And what we thought was that the kind of investments that they'd made over the last 3 years, it's quite possible that over the next 3 to 5 years, it would be time for them to start harvesting on these investments, and these investments would begin to pay off. And I think you're beginning to see that in the start of 2018, where a lot of the tier 2 IT companies have started to kind of get re-rated. And we still think this is the beginning. Of course, valuations have run up a bit in the last 3-4 months, but we still think that I think they should be fine over the next 3 to 4 years, provided you are a specialized player focusing on a specific domain or a capability and offering much better value to your customers.
So you back then you believed that the investments that they have done will start bearing the results, and there was a general shift in the demand climate. I mean, am I getting this correct?
Yes, I think that's bang on out there. And the fact that, of course, the world economy looked or seemed to be in a much better shape, okay, versus where it was 3 years or 5 years back. And when that starts to happen, a lot of discretionary spending starts to kind of come in. And obviously, of course, technology would be a disproportionate beneficiary of that. And within that, of course, India conventionally has been always having a cost proposition to offer. So India has been able to offer fantastic services in the technology space at a reasonable price. So there's clearly a value up proposition which the Indian technology sector were to happen. And last few years have been tough for them on terms of the currency side. And it's quite possible that even a little bit of weakening of the rupee or a little bit of appreciation of the dollar over the next couple of years really could add to their margins, which in turn basically could drive growth for these companies.
So is it the dawn of the age of the second-rung IT companies from India? Well, find out that and much more in the entire conversation that will play out at 10:30 a.m. on Bloomberg Quint Live. Let's take a check on the rupee and the bond market. Saloni Dhanuka joins us with all the details there. Morning, Saloni.
Good morning, Alex. So the rupee yesterday ended little changed at 65.66 levels against the dollar. Now with a marginal fall of 2 paise, the rupee extended its downward movement for the third consecutive session yesterday. Remember, the home currency had fallen to an intraday low of 65.79 levels in the early trade yesterday. However, according to a lot of dealers, RBI suspected intervention in the currency market helped the rupee recover to a day's high of 65.59 levels yesterday. Also, Edelweiss currency dealers expect rupee to decline to 66.25 to 66.50 levels against the dollar in the next 3 to 6 months if oil prices continue to trade above the 70 mark. Well, speaking about the bond market, sovereign bonds declined yesterday as yield on the new 10-year benchmark security ended 5 basis points higher at 7.54%. Now, in terms of flows into debt market, global funds reduced their rupee debt holdings yesterday for the 4th consecutive session. They reduced their debt portfolio by close to 2,240 crores according to NSDL data. Well, speaking of on the global front, the dollar gained for the third straight session. Yesterday, it trades near 89.70 levels in the early Asian hours. Now, dollar index is largely supported by an increase in US Treasury yields, which trades near 1-month highs of 2.89%. And lastly, speaking of dollar rupee, now it is trading at 65.72 levels against the dollar in the non-deliverable forward markets, which indicates a negative opening for Indian rupee in today's trade, Alex.
Thanks so much for that, Saloni. Let's move on to a special update for you from the Reserve Bank of India. RBI Deputy Governor N.S. Vishwanathan put up a very spirited defense of the February 12 NPA management guidelines. There was an entire revamp in the guidelines that they issued on that day. Speaking at an event in Pune, he said that the central bank's action was to restore the sanctity of the debt contract more than anything else. Vishwanath Nair sums up the key highlights from that speech in this report.
So N.S. Vishwanathan, the Deputy Governor of the Reserve Bank of India, in a speech earlier pointed out the need for the February 12th guidelines on NPA management to be implemented in the way that they have been perceived by the Reserve Bank of India. This speech by an RBI Deputy Governor comes on the back of a lot of debate on whether the February 12th guidelines are very stringent or too stringent for the banks, and whether there is a need to dilute some of these norms. So much so that this debate has now reached the government, and a parliamentary committee will be talking to the Reserve Bank governor, trying to get him to agree to dilute these norms. But the Reserve Bank is pretty steadfast in its approach, and let's hear what N.S. Vishwanathan has to say about this matter. The reason why he wants these guidelines to be implemented in the form that they have been intended is because he feels that the debt contract that is embedded in, especially in some of these larger loan cases, the sanctity of them is continuously on a decline, and that is something that needs to change, according to the Reserve Bank of India Deputy Governor. He points out that unless this changes, there is a chance that bank debt may become subordinate to even equity in the scheme of things. So that is primarily the reason why the Reserve Bank wants these guidelines to be as tough as they are currently. But what is exactly the problem with the sanctity of debt? Well, that is explained in this quote, wherein Vishwanathan asked the bankers to be a little more proactive when they are dealing with stresses and when they're dealing with NPAs. He points out that default in a company is not something that comes after stress. It's a lagging indicator. It's in the sense that stress already existed in the company, and that is why the company is defaulting. So banks, as institutions that lend to these companies and have an intention to recover their money from these companies, need to be more proactive, and they need to come up with ways to deal with this financial stress using a combination of leading indicators and renegotiation points. He says that you bring these points in, and only then can you adequately deal with default. Now, the reason why he's bringing this up is because in the guidelines there is a specific norm which states that banks need to spring into action the day after a company has defaulted on its loan. Many banks feel that this is probably too stringent. In fact, the Indian Banks Association has submitted a letter to the Reserve Bank as well as the government, asking for a 30-day rectification period within which the banks will figure out how to deal with this company and then spring into action. What the Reserve Bank feels is that you had your time to actually figure out the course of action. That was before default, and after default there is the need for you to actually stay true to your word and actually start something that will ensure that the default is corrected and the company comes back into repaying mode. Finally, he points out a set of risks that are inherent in the banking system. There has been this trend that most banks have been focusing only on the retail and the personal loan segment, so to grow their books and to have a higher retail portfolio. But the Deputy Governor of the Reserve Bank points out that you cannot treat retail lending as some kind of risk-free area which is a grand panacea for all your problems in the loan book. He says that unless you want the problems of the past, you have to ensure that the growth that comes in the next cycle is a measured growth, is something that is taken with conscious decision making and after thorough risk examination. Only then can you grow your loan book. Otherwise, you will end up with more stress in the coming years.
All right, lots to tell you about in the commodities space with oil and metals in focus. Jayesh Khilani is back to tell you all about that. Jayesh, over to you.
Morning, Alex. Let's start off with oil prices currently trading about 0.4% in the green. But this is on the back of a big near 3% move overnight that we saw for WTI. In fact, WTI has climbed to the highest level since 2014 on the back of an inventory decline of as much as 1.07 million barrels for last week, as reported by EIA. Also, we understand that OPEC and Russia will be meeting Saudi Arabia later this week, so we'll stay on top of that story and get you all the updates from that development. But as far as base metals are concerned, the index on London Metal Exchange surged more than 3%, and in fact it surged most since Feb 2017. The big gainers over there were aluminium and nickel. So aluminium actually posted a 5% gain for the second day out of the last 3 days that it has surged, and nickel actually surged the most since October 2011 and saw a 7.5% up move for itself. Among other base metals that we were tracking, copper and zinc. So copper actually ended 2% higher, while we had zinc which ended about 3.5% higher. Now you can see that most of these base metals have shown a similar kind of opening on the Shanghai Futures Exchange, with steel actually trading about 2 to 3% higher. Also on the precious metals front, gold in fact closed above the 1350 mark, though currently trading absolutely flat.
Thanks so much for that, Jayesh. Now moving on to the earnings season, ACC was the first cement major to report earnings last evening, and most of the parameters, it essentially surpassed most of the parameters with regard to analyst estimations. Nikki Mirchandani is here with more. Nikki, it was an operationally strong quarter evidently for ACC.
Right, true that. Top line as well as volume growth has been in line with estimates. Operationally, however, it's been a strong quarter for the company. If you can look at the net sales figure, 14.4% rise is what the company has registered on year-on-year basis to a number of 3,556 odd crore, which is in line with estimates. EBITDA has risen as much as 18% to 491 crore as compared to the Bloomberg consensus decline that we were looking at on year-on-year basis. Margin has risen almost stayed stable at 13.8 as compared to 13.4. Profitability has increased 16% year-on-year basis for this company. The main beat is coming in from the volume figure, which is coming at 7.7% to 7.1 million ton. EBITDA per ton has also increased to 9.5% to 691 to rupees 691, and realization has also inched up by as much as 6.2% year-on-year basis. So what has led to good set of numbers? Higher realization and cost optimization techniques undertaken by the company. The main operational efficiencies coming in from the decline in the raw material expenses, which is a percent to your net sales have declined to 16% from 24% that we've seen. However, the profits would have been higher had it not been for higher power, fuel and freight and forward expenses. Now, power and fuel expenses as a percent to your net sales have risen to 21% from 15% that we've seen in March quarter, while freight expenses too have risen to 28% from 21% earlier.
Thanks, Nikki, for that. Now, clearly, one of the big two earnings that you'll have to look forward to today, albeit after market hours, is going to be Tata Consultancy Services. And after Infosys cut its margin guidance for the current financial year, everyone's watching for whether TCS will follow suit. Well, Agam Vakil is here with all the key updates and all the key expectations from TCS. Agam, over to you.
Thanks for that, Alex. Well, we're expecting a very strong quarter for TCS. Let's start off with expectations on the revenues front. And as you can see, in terms of dollar revenues, about an uptick of 2.3%, 2.4% uptick in rupee terms. And this is, of course, on a sequential basis. Coming down to your profitability, again, we're expecting margins to expand to a certain extent at around 25.5%, below the mark of 26% indicated by the company. But we'll have to watch for whatever they are saying with respect to margins, and profit is expected to move up by as much as 4.3%. In terms of key factors and the reasons why we are expecting strength in this particular quarter is because of the fact that we're looking at we're looking at Scottish Widows as well as some other deals from such as Okay, so we do have recent deals coming in, and which are front-ended, which will play a part with respect to strength coming in for TCS. And of course, we're also looking at advantages coming in from cyclical spending, and that should be an uptick as well. Of course, revival in North America will be key, considering a substantial amount of revenues are coming there. And among many other factors that we are watching out for will, of course, be whether or not we can actually see a substantial uplift in the BFSI space. And do remember, the company has had a wait-and-watch strategy on the banking and financial space, at least up till now. And of course, the digital revenues. Now, while TCS has seen a substantial gain and the robust growth in digital revenues and digital services, we're going to have to wait and see whether or not that continues to slow because of the base now eventually expanding. So those are some of the factors that we'll be watching out for, but we're expecting a good quarter from TCS, certainly a better in terms of growth when compared to Infosys.
All right, thanks so much for that, Agam. Let's move on to the other earnings that you have to watch out for. IndusInd Bank is set to report a strong quarter, with net interest income likely to rise nearly 19%, while net profit is likely to grow more than 25% on a year-on-year basis. Among other factors to watch is the strong commercial vehicle cycle that may keep loan growth between 20 and 25%, and asset quality that is likely to remain stable. Now, what are you going to look forward to in the press conferences that happens today, this afternoon? Comments on growth, the net interest margins, and of course, credit cost guidance will be the key aspects to watch out for. All right, Shraddha Babla is here with the stocks in news. Shraddha, clearly TCS and TCS, of course, ahead of its earnings, and IndusInd will be keen to watch. But what are the other stocks that are in the news?
So Alex, two companies which reported earnings after market hours yesterday. Mindtree, very good set of numbers. Revenues up by 6%, net profit up 29%, and margins also expanded by 150 basis points. So that was a beat there. Even a strong set of numbers coming in from HDFC Standard Life Insurance. The net premium income grew by 24% and the net profit was up by 40%. So these are two on the back of earnings. That apart, we also are watching out for Fortis Healthcare, for which the board will meet today to evaluate and take stock of the various bids that have come in. That apart, there's also a press release to the stock exchanges saying that they've received a special note from 3 investors who hold as much as 12% stake together to hold an EGM to remove certain directors and appoint some of the others. So a lot of developments on Fortis Healthcare. Watch out for that name. In fact, according to a ET report, KKR-backed Radiant Life is also readying a bid for Fortis. So watch out for that name. That apart, NMDC has cut prices of lump ores and fines by about 3.5%, one of the sharpest cuts in the last 6 months or so. Watch out for that name. Infibeam has received a contract for providing an online marketplace. Trigon Technologies, a smaller IT company, but they've received 3 IT services contracts in the USA, so you might see some positive reaction there. Dynamic Products has got a closure notice from Ankleshwar unit from the Gujarat Pollution Control Board. Negative development there. Bharat Dynamics has signed a licensing agreement with the Defense Research Organization. So those are some of the names you need to watch out for.
Thanks so much for that, Shraddha. Let's move on now. We're at the end of the show because we've completely run out of time. I was hoping to give you something else to talk about, but you'll have to tune in to the next show. That's all you need to know for exactly what we have for you, and that's a special slice of a conversation on Rajpath. Well, that's all we have for you on Daybreak. Thanks for watching. This is Bloomberg Quint.